And moving on to question number 9 here, we're going to start the chapter 16, which is convertible securities, stock options, derivatives, and how it relates to your equity balances. So on January 1, 2012, we had Shark Corp. It granted an employee an option to purchase 9,000 shares of the 5 par value common stock at $20 per share. Per the model, this thing is worth a compensation expense of $210,000. The option became exercisable on December 31, 2013, after 2 years of service, and the market price of the stock was as follows. So what do we really need to know? There's so much information here, but keep in mind with stock options, I really want you guys to focus on just two ideas, especially for compensation plan. The period of the compensation and the total fair value of the stock. So in this case, they're telling us that the compensation expense is 210. So it's just 210. We have that right there. And it says also that it's related to 2 years of service. So for 2011, the idea is that he worked, this is one of the years of the compensation. So what are we going to have? We have period of compensation is 2 years. Total fair value of the stock, I believe, was $210,000. So both for 2011 and for 2012, we're going to have what? Payroll expense, option stock, option equity. And for how much are we going to have each time? It's just going to be 210 divided by 2. That's it. It really is it. 210 divided by 2. And over the 2 years, we're going to get back to the 110. Okay? So this is just what we have here as a function of 2 years. Okay? And the idea is that this way we have a solution of 105,000. So the solution is letter C for this one. Now moving on to question 10, okay, we have a bond here with an interest payment of 80,000, and they're converted to 1,600,000 shares of common stock, each having a par value of 45 and the market value of 54. And there's 3,200 of unamortized discount on these bonds, okay? And this is the book value method. So what is the entry to increase paid-in capital, okay? Now, let's see here. The bonds, so an interest payment date, 80,000 par, so 80,000 of Parco bonds were converted into 1,600 shares of common stock, each having a par value of 45 and a market value of 54. So 80,000, right? So what do we do in this journal entry first? How do we book it out? So bonds payable, we have 80,000 that we're going to debit, right? 80,000 because that's bonds payable. All right. We had unamortized discount on bonds, right? So this was a debit account, so we have to credit it to get rid of it, right? Okay. Now, let's see here. We have par value equity, right? So par value, let's see, is having a par value of 45 and market value of 54. So what's the remaining amount, guys? Okay, we have 1,600 of these shares, of common shares, a par value of 45. So I would put 1,600 times 45 in here and see if there's any room left for the rest. Right, so this is only 75,200, so I can see, so paid-in capital must be the remaining piece. Okay, so I'm getting 4,800 for the remaining piece, and that would be my increase in paid-in capital. Okay, so the reason being with this one is that what we did first is we got rid of the bonds payable. That was 80,000 that we debited. Then we credited 3,200 because there was an unamortized discount on this piece alone. So we had to credit it to take it off the book. Then the remaining, it goes to par value equity at $45 for every share. So 1,600 shares at 45 gives me 72,000 here. And now I have 4,800 left. That's the additional piece, goes to paid in capital. Keep in mind, with bond conversions, the idea is we just take the bond as is, and then we just put it into equity however much that bond value creates in equity. We don't really look at the market value here of the equity. That's just extra information. So the answer here is B, 4,800.